So raise your hand if this sounds like you. You have little investment experience, a smallish portfolio, and too many other things you'd rather be doing in your free time. If these traits apply to you, asset allocation ETFs might be just the ticket for your investment adventures. By using these single fund portfolios from Vanguard or iShares, you'll get diversified exposure to global equity and fixed income markets at a fraction of the fees charged by most mutual funds. I'm Justin Bender, Portfolio Manager with PWL Capital in Toronto. In today's episode, I'll help you decide which ETF provider is right for you, Vanguard or iShares. And spoiler alert, it actually doesn't matter much. Vanguard and iShares each have 5 asset allocation ETFs to choose from, with options for 20%, 40%, 60%, 80%, and 100% stocks. Each fund includes several underlying ETFs, which invest in thousands of individual stocks and bonds, providing Canadian investors with extensive global diversification. If there's one obvious difference between the Vanguard and iShares asset allocation ETFs, it's their annual fees. The iShares portfolios are slightly less expensive at around 0.20%, compared with 0.25% for the Vanguard funds. However, a 5 basis point difference is hardly a sufficient reason to prefer one company's funds over the other, especially in a smaller portfolio. For example, the fee advantage is only worth $5 per year on a $10,000 investment. Canadian stocks make up only about 3% of the global stock market, but Vanguard and iShares have both provided a higher weight to domestic stocks in their portfolios. In all 5 of their funds, Vanguard has allocated 30% of their equity mix to Canadian stocks and 70% to foreign stocks. iShares has split their equity allocation 25%, 75%. You may be tempted to favor the iShares ETFs with their higher allocation of foreign stocks. After all, during the decade ending December 2019, foreign stocks outperformed Canadian stocks by around 4.6 percentage points per year. But before you decide, check out how dramatically fortunes were reversed in the decade prior. From 2000 to 2009, Canadian stocks crushed foreign stocks by an average of 8.1 percentage points per year. In fact, if you had been invested over the past 25 years from 1995 to 2019, it would have made virtually no difference whether you had selected a 30%, 70%, or 25%, 75% Canadian foreign stock split. Both portfolios would have returned an average of 7.4% per year, and both would have had the same risk, with standard deviations of around 11.8%. So this decision isn't worth agonizing about. A 5% difference in Canadian stocks isn't likely to have a noticeable long-term impact on risk or returns. There is also a difference in how each company manages the foreign equity allocation within the portfolio. Vanguard weights their US, international, and emerging markets equity allocations based on their current market cap. This allows the asset classes to fluctuate freely within the constraints of the overall 70% foreign equity allocation, based on the relative stock market values in each region. For example, to calculate the target foreign equity allocation of Vanguard's asset allocation ETFs on September 30th, 2020, we would start with the market caps of the indexes tracked by Vanguard's US, international, and emerging markets equity ETFs. And dividing each region's individual market cap by the total of all 3 provides us with the target weights: 58.7% for US stocks, 30% for international stocks, and 11.3% for emerging markets. It's worth noting that these foreign equity weights are not static. They'll change over time. iShares has instead chosen specific target weights for their US, international, and emerging markets allocations. They stick to these target weights no matter what daily stock markets do. US equities receive a 60% share, with another 33.3% allocated to international equities, and the remaining 6.7% allocated to emerging markets. You'll notice that iShares significantly underweights emerging markets and overweights developed markets relative to Vanguard. The difference is even greater when you consider that South Korea is considered a developed market by Vanguard and an emerging market by the iShares funds. So if you prefer holding more emerging market stocks in your portfolio, the Vanguard asset allocation ETFs are the way to go. Within the portfolio's fixed income allocations, Vanguard targets 60% Canadian and 40% foreign bonds. They also hedge away the foreign bonds' currency risk, which makes them behave more like Canadian bonds. US, international, and emerging markets bonds are all included here. Similar to the equity allocation, the split between these foreign bond regions are determined by their current market caps, not by a specific target weight. Again, other than the 60%, 40% split between Canadian and foreign bonds, there's very little active decision-making going on here. This is ideal for those of you who prefer a more traditional approach to indexing. In comparison, iShares targets 80% Canadian and 20% foreign bonds in their portfolios, but that foreign allocation is entirely US bonds, split evenly between government and corporate investment-grade issues. Like Vanguard, iShares also hedges away the foreign currency risk. The iShares portfolios have also swapped out a portion of the broad market Canadian bonds for shorter-term corporate bonds, which has reduced the average maturity and duration of the portfolio. Lower duration means the bonds are less sensitive to interest rate changes. That lower duration may make the bond portfolio less volatile, but the extra helping of corporate bonds also adds a layer of credit risk. So the iShares portfolios may be right up your alley if you prefer more corporate bonds with less duration risk. When it comes to rebalancing, both Vanguard and iShares will take care of this for you. iShares plans to rebalance anytime an asset class drifts off target by 10% in either direction. For example, the iShares Core Balanced ETF portfolio, with ticker symbol XBAL, has a Canadian equities target of 15%, invested in the iShares Core S&P TSX Capped Composite Index ETF, with ticker symbol XIC. If XIC became more than 16.5% of the portfolio, which is calculated as 15% plus 15% times 10%, the managers would likely sell a portion to bring the asset class back in line with its target. Likewise, if XIC became less than 13.5% of the portfolio, which is calculated as 15% minus 15% times 10%, iShares would likely sell a portion of any overweight ETFs and use the proceeds to buy more XIC. In practice, iShares will typically use new cash flows to top up any underweight asset classes. This should reduce the need to rebalance by selling securities at a gain, which could be taxable to the ETF's unit holders. Vanguard's rebalancing plan is a little different. They won't allow any specific fund to deviate by more or less than 2 percentage points from its target weight. For example, the Vanguard Balanced ETF portfolio, with ticker symbol VBAL, has a Canadian equities target weight of 18%, invested in the Vanguard FTSE Canada All Cap Index ETF, with ticker symbol VCN. If VCN were to become more than 20% of the portfolio, 18% plus 2%, or less than 16%, 18% minus 2%, Vanguard would likely spring into rebalancing action. Again, they're more likely to use new cash flows to top up any underweight asset classes, reducing the need to sell existing securities. Two of the iShares Asset Allocation ETFs, XBAL and the iShares Core Growth ETF portfolio, with ticker symbol XGRO, are still eligible for pre-authorized cash contributions, or PACs, at Questrade. This program allows investors to automate their contributions and their share purchases, effectively putting their portfolio management on autopilot. XBAL and XGRO are also eligible for commission-free ETF trades at both Scotia iTrade and QTrade. So if you invest regularly through either of these brokerages, opting for the iShares versions instead of the equivalent Vanguard ETFs, VBAL or VGRO, will significantly reduce your trading costs. By now, I hope you've realized there's no clear winner here. An asset allocation ETF from either Vanguard or iShares would be a great choice for most investors. If you prefer one based on the factors I've discussed here, great. If not, flip a coin. Heads or tails, you win. I'm Justin Bender of PWL Capital, and if you enjoyed this video, please feel free to subscribe to the Canadian Portfolio Manager YouTube channel. And if you'd like to check out the historical back-tested performance of the Vanguard and iShares asset allocation ETFs, check out the CPM model ETF portfolios available on the Canadian Portfolio Manager blog.